The last time this happened, most people missed it completely. Not because the information was hidden, not because you needed connections on Wall Street, not because it required some kind of financial genius. They missed it because they were scared, and fear has a way of making the most obvious opportunities invisible. Here's the uncomfortable truth. Right now, a transfer of wealth is quietly underway that financial historians will write about for the next 100 years. We're talking about $124 trillion changing hands over the next 2 decades. To put that in perspective, that number exceeds the total annual economic output of every country on Earth combined. The last time anything close to this happened, regular school teachers, nurses, accountants became millionaires, not by luck, not by genius, but simply by understanding what was happening and refusing to sit on the sidelines. This video is about that moment and why it's happening again right now. Let's start with a simple question. Where do millionaires actually come from? Not the tech founders, not the hedge fund managers, not the people who got lucky with some speculative bet. The real answer is far less dramatic and far more accessible than most people realize. In 2010, the United States had approximately 8.4 million households. By the end of 2024, that number nearly tripled to almost 24 million. Think about that for a second. 15 million households crossed the $1 million threshold in less than 15 years. That's not a Wall Street story, that's a Main Street story. According to UBS's Global Wealth Report, the United States added 379,000 new millionaires in 2024 alone. That's more than 1,000 new millionaires every single day. Most of them weren't selling companies, most of them weren't collecting stock options. They were simply present, invested, consistent, patient. They owned index funds inside 401ks they barely thought about. They kept contributing when headlines were screaming catastrophe. They stayed in when every instinct said get out. Here's what most people get wrong about wealth creation events. They assume the opportunity looks like an opportunity while it's happening. It doesn't. It looks terrifying. It looks unstable. It looks like the worst possible time to be putting anything into. That's the whole point. Wealth doesn't transfer to the boldest person in the room. It transfers to the most prepared person who shows up when everyone else is frozen. Now here's where the current moment gets genuinely interesting. What's unfolding today isn't a market crash. It's not a sudden opportunity that requires split-second timing. It's something slower, more structural, and in many ways, far more powerful than any single market bottom. It's a generational handoff of the largest concentration of private wealth ever accumulated in American history. And unlike the chaos of 2009, this one comes with a 25-year runway. You don't need to time the bottom, you just need to understand what's moving and make sure you're positioned in its path. The mechanics of how that works are exactly what we're going to break down next. Let's talk about the actual number, because when you hear it, your brain will probably try to dismiss it. That's normal. Human beings are genuinely terrible at processing numbers this large. $124 trillion. That is the estimated value of assets that will change hands in the United States between now and 2048. This is what researchers are calling the Great Wealth Transfer. And it is not a prediction, it is not a forecast, it is demographics doing math. Here's how it works. Baby boomers, those born between 1946 and 1964, currently control approximately 52% of all private wealth in this country. That's roughly $78 trillion concentrated inside a single generation. The youngest boomers turn 62 this year. The oldest are approaching 80. Over the next 2 decades, that wealth moves to children, to grandchildren, to charities. Generation X stands to inherit approximately $39 trillion. Millennials, approximately $46 trillion. Even Gen Z will begin receiving significant transfers as the wave accelerates through the 2030s. Now here's the part most financial coverage completely ignores. The opportunity isn't just about who receives an inheritance. Most people won't receive a life-changing inheritance. The math on that is actually pretty sobering. Approximately 62% of the wealth being transferred comes from high net worth and ultra-high net worth households. That's only about 2% of all American families. So yes, the headline number is staggering, but the distribution is highly concentrated. The real opportunity is what $124 trillion in motion does to the broader economy around you. When that much capital changes hands, it doesn't sit in a vault somewhere. It gets reinvested, redeployed, redirected into markets, into real estate, into businesses, into entirely new asset categories that younger investors prefer over traditional stocks and bonds. Every dollar in motion creates turbulence, and turbulence creates opportunity for people who understand what's happening. The last comparable event in American history was the post-World War II economic expansion. Returning soldiers, GI Bill, suburban housing boom, a middle class built almost from scratch. That wealth creation event produced the very generation now transferring its assets. History doesn't repeat exactly, but the underlying mechanics are remarkably familiar. And the people who studied those mechanics last time didn't end up watching from the sidelines. Here's the uncomfortable part. Everything we just discussed is publicly available information. No subscription required, no insider access needed, no connections on the 43rd floor of some Manhattan office building. The research is sitting in reports published by Cerulli Associates, UBS, Bank of America, available to anyone willing to spend 30 minutes reading. And yet, most people will do absolutely nothing with it. Not because they're unintelligent, not because they don't care about their financial future, but because of something far more predictable and far more stubborn: short-term thinking. The average American spends more mental energy researching a $49 Amazon purchase than thinking about where their wealth will be in 25 years. That's not an insult. That's just how human psychology is wired. We are built for immediate threats, immediate rewards, immediate feedback. A 25-year wealth transfer doesn't trigger any of those instincts. Neither did the 2009 market bottom while it was actually happening. At that moment, every psychological signal said wait, every headline said danger, every conversation at every dinner table said this is not the time. And the people who listened to those signals watched from the sidelines while one of the greatest wealth creation periods in American history unfolded without them. Goldman Sachs research tells a particularly brutal story here. Missing just the 10 best market days since 2009 reduced annual returns from approximately 17% down to approximately 12%. Missing the 25 best days cut returns nearly in half. Here's the cruel irony. Those best days almost always happen during the most frightening periods, when volatility is highest, when the news is worst, when your instincts are loudest. The cost of sitting on the sidelines isn't just the gains you missed, it's the compound growth on those missed gains for every year afterward. That's the tax that fear charges you, and it collects silently for decades. The great wealth transfer operates on the same psychology. It will be punctuated by recessions, by corrections, by crises, by headlines insisting that this time is different. And at every one of those moments, a portion of people will exit, convinced they're being smart, while the underlying force, $124 trillion seeking deployment, continues moving, entirely indifferent to short-term market noise. The question was never whether this transfer would happen. The question is simply which side of it you'll be on. Let's get specific, because inspiration without mechanics is just an expensive feeling. The people who built real wealth after 2009 didn't use complicated strategies. They used boring ones, executed consistently over long periods of time.
That's it. That's the whole secret. So let's talk about what that actually looks like in real American households right now. Start with tax-advantaged accounts. This is not glamorous advice, but it is the single most reliable wealth-building mechanism available to ordinary Americans. For 2026, the 401k contribution limit is $23,500 annually. If you're 50 or older, you can add another $7,500 in catch-up contributions. That's $31,000, growing with zero annual tax drag. Every dollar you don't put in there is a dollar getting taxed before it even gets the chance to compound. That's not a missed opportunity, that's a self-inflicted wound. Next, broad market exposure. Don't try to predict which sectors will capture the most wealth transfer tailwinds. Nobody knows. Anyone who tells you otherwise is either guessing or selling something. Own the entire market through low-cost index funds. When $124 trillion flows into various asset classes simultaneously, broad exposure ensures you participate in the aggregate rise. You don't need to pick the winner, you just need to be in the race. Now, here's where the math gets genuinely motivating. A 35-year-old today, investing $500 monthly in a diversified index fund at the historical average of 10% annually, accumulates approximately $665,000 over 25 years on just $150,000 in total contributions. Increase that monthly contribution to $1,000 as your career progresses, and that number crosses $1.3 million. Regular people, millionaire status, consistency alone. No stock picks, no timing, no genius required. Third, build a cash reserve for opportunistic deployment. The wealth transfer will create dislocations, moments when assets temporarily misprice. Having capital available when others are forced to sell is one of the oldest and most reliable edges in investing. You can't take advantage of a discount if you spent everything getting to zero. Liquidity is not laziness. Liquidity is optionality. And optionality in volatile periods is worth more than most people ever calculate. The strategy isn't complicated, it just requires discipline that most people find incredibly difficult to maintain when it matters most. Understanding that wealth is transferring is one thing. Understanding where it flows next is where preparation becomes advantage. Research from Bank of America reveals something genuinely important here. 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns through traditional stocks and bonds. 72%. That's not a fringe opinion. That's a generational shift in investment philosophy about to redirect trillions of dollars. Baby boomers favored blue-chip stocks, dividend payers, municipal bonds, predictable and familiar instruments. Their heirs have different preferences entirely. Artificial intelligence infrastructure, clean energy, healthcare innovation, alternative investments, direct company ownership. As $46 trillion moves towards millennials and $39 trillion towards Generation X, the capital flowing into these sectors will be significant, sustained, and structural. This doesn't mean abandoning traditional investments. It means recognizing that capital flows are shifting and that sectors attracting younger investor preferences may outperform meaningfully over the next 2 decades. Now let's talk about real estate, because the wealth transfer will reshape housing markets in ways that are already becoming visible. Markets where boomers concentrated, certain suburban corridors, retirement destinations, may see increased inventory as inherited properties enter the market. Meanwhile, markets where younger generations want to live and work will face intensified demand as newly wealthy millennials pursue home ownership. The divergence is already documented. Median home prices have risen over 150% since 2000, but that appreciation has been profoundly uneven. The same $500,000 deployed in a high-growth metropolitan market versus a population-declining market produces dramatically different outcomes over a 25-year period. Geography is not a lifestyle preference. Geography is a capital allocation decision. There's also a demographic detail that most coverage on this topic completely ignores. Approximately $54 trillion will first pass to surviving spouses before eventually transferring to the next generation. Nearly $40 trillion of those transfers will go to widowed women. Women are about to become the primary controllers of unprecedented private wealth in this country. The financial services industry is only beginning to reckon with that reality. Advisors, planners, and wealth managers who understand this shift are already repositioning their entire practice around it. The money isn't coming, the money is already moving. The only question that remains is whether you understand the current well enough to swim with it rather than against it.
Let's talk about the part nobody likes to discuss, because strategy is easy to write down. It's significantly harder to execute when your retirement account drops 20% in 6 weeks. Here's what the historical record actually shows. The period after 2009 didn't feel like a golden age while it was happening. The European debt crisis hit in 2011. The government shutdown rattled markets in 2013. The trade war created chaos in 2018. The pandemic erased 34% of market value in 33 days in 2020. 2022 delivered a bear market that wiped out nearly 20% from the S&P 500. At every single one of those moments, credible voices, serious analysts, respected institutions suggested the long rally was finally over. At every single one of those moments, they were wrong. The S&P 500 crossed 2,000 in 2014, then 3,000 in 2019, then 4,000 in 2021, then 5,000 in early 2024, then 6,000 in late 2024, then 7,000 in January 2026. Each threshold felt uncertain while approaching it. Each threshold felt obvious in retrospect. That gap between uncertain and obvious is exactly where wealth gets built, or permanently lost. The investors who accumulated real wealth through this period shared one defining characteristic: not intelligence, not sophistication, not access to better information. They simply refused to let short-term discomfort override long-term positioning. That sounds simple. It is genuinely one of the hardest things a human being can do with money, because the pain of watching your portfolio fall is immediate, visceral, and very real. The reward of staying invested is abstract, distant, and easy to rationalize away. Your nervous system cannot tell the difference between a temporary correction and a permanent loss. It treats both identically, which means every correction feels like the one that won't recover. The great wealth transfer will test this psychology repeatedly over the next 25 years. Recessions will come, markets will correct, headlines will be terrifying, and the underlying transfer of $124 trillion will continue, completely indifferent to whatever is trending on financial news that particular Tuesday. Staying in is not passive. Staying in during chaos is one of the most active and most consequential decisions a serious investor makes. Let's do the math together, because abstract concepts about wealth transfer mean little more than concrete numbers attached to them. Let's start with a real American household, 35 years old, combined household income of $90,000 annually, mortgage, car payment, maybe some student debts still lingering. Investing $500 per month into a broadly diversified index fund, nothing exotic, nothing complicated, just $500 every single month at the historical average market return of 10% annually. Over 25 years, that $500 per month on just $150,000 in total contributions becomes approximately $665,000. Let that land for a second. $150,000 in, $665,000 out. Now, apply even a modest tailwind from the great wealth transfer, pushing economic growth just 1 percentage point above historical averages. That 10% becomes 11%,
The outcome shifts to approximately $750,000 from the same contributions, from the same discipline, just from understanding the environment you're investing inside. Now, let's talk about what happens when careers progress and contributions increase. That same household increases monthly contributions to $1,000 by age 45. At 10% annually, the 25-year outcome crosses $1.3 million. Regular people, millionaire status. No stock picks, no insider information, no dramatic financial reinvention, just consistent capital allocation inside tax-advantaged accounts over a long enough time horizon. Here's where the employer match conversation matters enormously. The average 401k employer match in the United States is approximately 4% of salary. On a $90,000 income, that's $3,600 annually added to your account that you did absolutely nothing to earn. That's $300 per month in free capital, compounding alongside your contributions for decades. Employees who don't capture the full employer match are quite literally leaving money on the table every single pay period. Not metaphorically, literally. The math on not maximizing that match over a 30-year career can represent hundreds of thousands of dollars in unrealized compound growth. Wealth destruction with excellent benefits packaging. The numbers aren't complicated. They never were. What's complicated is convincing yourself that the future version of you is worth the sacrifice the present version of you has to make today. That's the only real equation that has ever mattered in personal finance. Here's something most wealth transfer conversations skip entirely. You don't have to be an investor to benefit from $124 trillion in motion. When that much capital changes hands, entire industries expand simply to facilitate the movement. Financial planning, estate administration, tax advisory, wealth management, trust and estate law, real estate transaction services – these aren't glamorous career pivots, but they are recession-resistant, demographically guaranteed growth industries for the next 25 years. The clients are already arriving. The share of millennial and Gen Z clients at high-net-worth-focused financial firms grew from just 8% in 2021 to 25% by 2024.
That's a threefold increase in 3 years. Advisors who understand younger client preferences are capturing business relationships that will compound in value for decades. Consider the adjacencies too. Technology platforms serving wealth management, software handling estate administration, healthcare services supporting aging boomer populations whose wealth is about to transfer, senior housing, elder care logistics, assisted living infrastructure. Every single one of these sectors grows directly and predictably as the boomer generation ages through its final chapters. This isn't speculation. This is demographics reading a calendar. The point is straightforward. Positioning for the great wealth transfer doesn't require you to be a passive investor waiting for compound interest to do its work. It can mean actively building skills, developing expertise, or entering industries that sit directly in the path of the largest capital movement in American economic history. Capital in motion creates opportunities far beyond the investment account. The question is simply whether you're paying close enough attention to recognize them. Let's bring this full circle. The school teacher who invested $50,000 at the 2009 market bottom didn't have special information. She didn't have a financial advisor whispering in her ear. She simply understood that fear had created value, and she acted while everyone around her was paralyzed. That $50,000 became approximately $590,000, not because she was brilliant, because she was present and prepared at the right moment. The great wealth transfer is that moment extended across 25 years. $124 trillion already in motion, 15 million new millionaire households created in the last 15 years alone, more being created every single day. The information is public, the mechanics are documented, the timeline is known.
What separates the people who benefit from the people who watch from the sidelines has never been access. It has always been the willingness to act on what they already knew. Maximize your tax-advantaged contributions. Own broad market exposure. Extend your time horizon. Build liquidity for opportunistic moments. Understand where capital is flowing and position yourself in its path. That's it. No secret formula, no exclusive strategy, just disciplined execution of straightforward principles during one of the most significant wealth creation periods in American history. You now understand what's happening. You understand the scale. You understand the timeline. You understand the strategies. The only thing left is the decision. If this gave you genuine clarity, share it with someone who needs it. And if you want to go deeper, the next video is already waiting for you.